It is a force so powerful that it can evaporate millions of dollars overnight, turning brilliant minds into cautionary tales and transforming ordinary people into victims of their own minds. We like to believe that the financial markets are built on pure logic, mathematics, and rational calculation. But beneath the surface of the charts and ticker tapes lies a much darker reality. The truth is that the stock market is driven by human psychology. The field of behavioral finance examines how psychological factors and cognitive biases influence our financial decisions, often leading to market bubbles, massive fluctuations, and costly mistakes. Today, we are going to dive deep into the 5 psychological traps that have quietly destroyed fortunes throughout modern history. These are the 5 mental traps of investing, and more importantly, this is how you can escape them. Trap number 1, overconfidence. It is human nature to overestimate our own abilities, and this illusion of control is one of the most dangerous biases in finance. Consider this strange psychological fact. A staggering 78% of Americans consider themselves to be better than average drivers. This exact same blind spot bleeds into the financial world, where 64% of investors confidently believe they possess a high level of investment knowledge. This cognitive bias prompts individuals to take excessive risks, believing their own predictions are more accurate than they actually are. We saw this trap spring shut during the dot-com bubble of 2000, when immense overconfidence fueled a market frenzy as investors wildly overestimated the potential of internet startups, leading to inflated valuations and an eventual devastating crash. The abundance of online information today only exacerbates this trap, giving amateur traders the illusion of comprehensive understanding. The reality? In 2023, only a quarter of actively managed mutual funds actually managed to outperform a market over the previous 10 years. How do you escape? Professional financial experts recommend a psychological exercise known as a pre-mortem. Before placing a trade, imagine a scenario 10 to 15 years in the future, where your investment has completely failed, and systematically analyze the structural causes of that failure. This forces your brain to evaluate pitfalls logically rather than running on pure ego. Trap number 2, herd mentality. There is a terrifying pattern in the study of human behavior. Just 5% of informed individuals can influence the decisions of the remaining 95%. Herd behavior emerges when investors abandon independent analysis and instead make decisions based primarily on the actions of the group, driven by the ultimate psychological fear, the fear of missing out, or FOMO. Investors blindly follow the crowd into market bubbles. We witnessed this modern madness during the 2021 cryptocurrency boom, where retail investors rushed to buy digital assets like Bitcoin, pushing the price to a record high of $69,000 in November 2021 before a sharp and punishing correction. This same herd behavior fueled the 2021 meme stock frenzy, where social media hype surrounding companies like GameStop and AMC caused volatile price surges. To escape the herd, you must build a solid, predetermined investment plan based on your personal risk appetite and historical trends, rather than emotional, reactive selling or buying. Trap number 3, loss aversion. Why is it that the pain of losing feels so much worse than the joy of winning? Loss aversion research proves that investors experience the emotional impact of losing money far more intensely than the satisfaction of an equivalent gain. This psychological pain traps people into a destructive cycle known as the disposition effect. Under this spell, investors will quickly sell their winning assets to lock in profit, but they will stubbornly refuse to sell their declining investments, holding on to a stock that has dropped 40% in the irrational hope that it will eventually recover. This emotional bias was devastatingly prevalent during the 2008 financial crisis, where paralyzed investors held on to plummeting stocks to avoid realizing their losses, completely missing the subsequent rebound in safe haven sectors. Escaping this trap requires strict discipline. Investors must set predetermined exit strategies, such as stop-loss orders, and evaluate an asset based on its current factual market value, rather than its initial trading price. Trap number 4, anchoring bias. The first piece of information your brain receives is usually the most powerful. Anchoring causes investors to place a dangerous amount of weight on initial data points, leaving them unable to adjust to new, changing realities. A haunting example of this occurred during the COVID-19 market sell-off in 2020. Investors clung desperately to the pre-pandemic prices of oil stocks, anchoring their expectations to an outdated reality and completely overlooking the market's massive shift toward renewable energy. They held on to stocks that were trading at drastically reduced prices simply because they were anchored to the higher price they initially paid, ignoring poor fundamentals and a lack of recovery prospects. To break the chain of the anchor, you must regularly reassess your investments using forward-looking metrics, actively challenging your own assumptions about historical trends. Finally, trap number 5, heuristics, also known as the mental shortcut. The human brain is lazy. It loves to simplify complex decisions by relying on stereotypes and recent, vivid information. This leads to the representativeness heuristic, where investors judge an opportunity based purely on its similarity to a familiar pattern. Look no further than the recent artificial intelligence craze. Investors began blindly piling their money into firms merely for the exposure to AI. Companies that simply mentioned AI in their earnings calls or corporate descriptions saw an average stock price rise of 4.6%, nearly double the gain of companies that did not, regardless of their actual financial fundamentals. Investors bought in quickly, skipping the crucial step of analyzing the company's financial statements or management quality. To escape the trap of heuristics, you must implement systematic checklists to evaluate investments, forcing your brain to slow down and process the data rather than jumping to an emotionally comforting conclusion. Fortunes are not just built by choosing the right stock. They are preserved by mastering the mind. Heuristics, overconfidence, loss aversion, anchoring, and herd behavior. These 5 emotional biases account for the vast majority of financial ruin. The market is a mirror reflecting human nature. Escape these mental traps, and you will no longer be playing a game of chance. You will be investing with clarity, discipline, and purpose. If you want to continue uncovering the hidden histories and dark psychology behind the world's most fascinating mysteries, hit that subscribe button. Until next time, keep your mind sharp and your investments protected.